You can't control what the future holds, but you can take control of your investments with principle. Whether your goal is to enjoy a comfortable retirement or to secure your financial legacy for future generations. After all, your future and aspirations are worth investing in. That's why we offer a wide range of fund options that gives you global and local exposure for better returns. With more than 142 years of global investment experience at your fingertips, you can take full advantage of opportunities to build your wealth. And we make it easier for you to manage your investments with our enhanced digital solutions. Now you can easily buy, redeem and switch your investments at your own convenience with our easy-to-use online investment portal. Never miss the right opportunities to invest with cash or iInvest. As you build your legacy and aspirations, we will be by your side to help you secure the future for you and your loved ones. Start taking control of your investments with principle today.
Assalamualaikum and good evening, everyone. Thank you for joining us today. So this is our first webinar for this quarter. In fact, the third of this year. My name is Nazri and I'm your moderator for today. So today will be an interesting topic to be addressed, which is managing risk in a complex world by our expert presenter, Mr. Wu Mantai. He is our head of investment services. So a bit of his background, Mr. Wu has close to 3 decades of experience. So since 2000, he has served as a portfolio manager for both international and domestic equities. So before we start, a reminder, should you have any question during the presentation, please type it in the chat box. Our presenter will respond it after later. So due to time constraint, the question will be the most liked will be answered first. So hence, click like for question that you think is beneficial. So without further ado, I pass the floor to Mr. Wu. Over to you, Mr. Wu. Thank you very much.
Hi, good evening, everyone. Thank you for participating in today's course. Please allow me to share presentation material. Hi, good evening. Paying attention to risk in a complex world is like managing risk in a complex world. The world has always been complex, but because of lack of volatility of things flaring up, people sometimes ignore the risk. But I think recently there's a number of events that bring people's attention to managing risk. All right. Let me just go straight through before I talk about the main topic. I'd like to highlight the fact that even in periods of volatility, periods of higher risk, you'll notice that there are still products that you can invest in and make money. I think this support the argument that one should always stay invested and always talk to an expert and talk about opinion where you can get the best exposure in a different every environment is different. There's always some changes, and at this point the ASEAN product is the best performing, and to some extent the Malaysian conventional products is also performing. I'll explain a little bit why the Sharia compliant products or in Malaysia are not performing, even though the performance are generally quite good and stable despite the high volatility that we have seen in the region. All right. Now that I finished with the cliche of staying invested, let's go on to other materials. I think beginning of the year or towards the final quarter of the last year, the main concern of the world is, would there be a new dangerous COVID variant? And what would be the Federal Reserve be doing in terms of interest rate hikes? All right. And effectively, that created quite a bit of uncertainty, and people don't know how to position their portfolio as per the lack of clarity on the interest rate trends around the world. And unfortunately, we have the war that broke out between Russia and Ukraine, whereby Russia invaded Ukraine. Just as an example, since this is a geopolitical issue, and this is something that most of us are actually 99% or 99.5% of us are not an expert on, but based on past experience, previous confrontation, January by 6 months after that, most of the markets will have come back if you look at the final column here, right? And one thing I like to highlight is that a war is a very expensive endeavor. For example, today Russia said that they lost a warship. That's easily 500-600 million or even more than $1 billion to build in current terms. So war is something that drains on your finances, and usually you have to be financially generally very strong to even have a war. And realistically, I think with most nations financially weakened after the COVID-19 lockdown, I think generally the war do not benefit anyone. And we hope that hopefully by middle of this year, all the parties involved will be able to sit down and have a discussion on how to settle the issue. All right. Now, with the geopolitical event, I think we have no choice but to generally focus on things, on the fundamentals and developments that we are able to grapple with, and in the investment world that we are able to position ourselves in. For example, based on previous experiences of interest rate hike from 1987 right until 2015 after the 2008 global financial crisis, usually within 6 months after the first interest rate hike, the market will also be in positive territory, right? Effectively, most of the time after people get over the uncertainty of interest rate hike, whether it will affect the economic growth, I think in previous examples, generally after observing the interest rate hike do not have a significant impact on the global economy. People, the investors will focus on what is important, making money by investing. All right. I think at this point, if without the Russia-Ukraine war, I think this particular example that I've shown is very telling as to how should one want to position for going forward next after the interest rate hike. And especially, right, and also, of course, we do have the situation whereby part of the fear of the market correction is that once interest rate hike, technology sector would be affected. But here, I like to highlight two things. If you look at the blue line, which focus on the big major technology stocks, they do correct, but they are not as significant as those non-profitable, the black line technology stocks. How would this be? Well, if you remember, technology only came to being something more important in the world in the 70s and 80s with the rise of HP, Intel, and the likes. At the time, all of them are manufacturing companies. All of them borrow money to have factories, buy machineries, so they are geared. In periods of high interest rates and the profit base is not big and the technology sector is not as important as of now compared to previously, they will suffer when interest rates go up and down. Now, when fast forward to the current period, all the technology companies that matter in this world are the likes of Intel, HP, ASML, Microsoft, Apple, all that stuff, and Samsung, and even Tencent, and right, and TSMC in Taiwan. All these companies are huge. They are leaders in their sector. All of them are net cash. They do not have borrowings. If they have borrowings, because they export, they need to take LCs from the banks. And generally, they do not need to approach the banks for anything. The banks will approach them by virtue of the fact that they have lots of money, and the banks would want their money for deposits. Right? But what is different here is that the technology sector have a layer of very big, strong players who generally are immune, do not have any negative impact from higher interest rates. But you will continue to have new startups technology, you call disruption, new technology doing startup. And these are the people that in the technology sector that will suffer in current environment because of the volatility and higher interest rates. And the other thing that would have an impact on overall technology sector as well on the big cap companies, for example, take Intel as example, it has its own ecosystem. It will have its own customer base as well as supplier base. And their customers, Intel's customer could be highly geared, or the suppliers could be highly geared. And interest rate go up, one or two of the customers or few of the customers may go bust, or one or two of the suppliers may go bust. And that will somewhat affect, the day-to-day business operations of Intel. But as a whole, they will go through this quite well because they have multiple customers, they have multiple suppliers. They would not generally be fine. All right. But what would be the difference will be the new companies, those startups that is affected. As you can see in the black line, there's this index by Goldman Sachs which says non-profitable tech index. These are the companies that suffers in the current environment, right? Of course, you need to talk a little bit about oil prices. It's above 100, partly because of the Russia-Ukraine issue has made it worse. But OPEC, I'm sure, is fully aware of the fact that with oil prices being too high at above 100, it's actually negative for them in the long term because it just provides the incentive for people to search for alternative fuel. You have seen the rise of EVs. You have seen the rise of people talking about hydrogen as an alternative. So they know that they need to bring oil prices down to a comfortable level whereby to do significant research on alternative fuel is very costly. So generally, we believe that once things go back to normal, oil prices will range anything from 65 to 80 bucks per barrel going forward. And that will be the scenario. And if you look at this, other previously, when people talk about supply chain disruption contribution to higher inflation in US and across the world, partly had to do with the higher freight rates, as you can see in the top diagram, and of course at the same time higher commodity prices. But then you look in terms of future pricing, it has started to drop, and should the oil prices stop going for new highs, eventually the higher inflation issue numbers will start to taper, but it will be best resolved with the resolution of the Russia-Ukraine war, of course. But eventually the base effect and supply coming in will provide some relief to overall price inflation. All right. And of course, the other theme that we can see of is, of course, everybody is vaccinating very rapidly. I think a lot of countries in the world, I think all ASEAN 10 countries are reopening sharply on 1st of April. So you're talking about reopening place, domestically in particular, and to some extent, the foreign tourism play will start to come back perhaps towards second half of this year when people have more confidence of the fact that it's safe to do so. All right, and there is no deadly new variant in play. Next, let's talk a little bit about global projections. We think that this is projections available in January. It's a little bit high because US has already cut down their 2022 growth from 4% to 2.8. But even though if 2022 numbers are cut to, let's say, 3% or 2.8%, and global and advanced economies growth is cut to, let's say, 2.5%, and emerging markets cut to 4.5%. Generally, the momentum is still intact. This is hinged on the fact that the Russia-Ukraine issue do not prolong until year end. Then you'll come up with a different set of problems should that happen. I think what is important is to observe the trend in terms of quarterlies. You'll notice that by this quarter, second quarter, GDP growth in Asia Pacific, the dark blue line, will come back to lead the world. As per what happened after the first lockdown in 2020, when Asia Pacific come back strongly in terms of GDP, with China leading it. And that also we saw very strong capital market, equity market, bond market performance in Asia. And then it's only in second quarter last year when global developed country growth come back strongly, Asia's growth start to consolidate, that developed countries market performance lagged. But Asia Pacific continue to provide positive return, but at a lower level. So if there is going to be a reallocation of resources of fund managers will be looking at the growth, then perhaps there is a likelihood that there could be reallocation to Asia Pacific region once the growth momentum is seen. All right. So you do have a potential reallocation from developed countries back to Asia Pac, as per what you saw last year, from Asia Pac to developed. And if there is a case, it provides a strong argument as to how you want to position your overall portfolio tactically or strategically on Asia Pacific as well as the developed countries. I'd like to highlight a few things based on the Federal Reserve guidance that was provided in the previous minutes. I'd like to focus on point number 1, number 3, and number 7. Number 1 is they did raise interest rates by 25 basis points in March and talk about 6 more interest rate hikes this year and a few more next year. What you have done is provide for the first time a very clear trend of interest rate direction. This is the first time they ever do something like that. And if you are a businessman and you are the finance director of a company that uses US dollar, and what it means is you will be able to better plan your financials and your budgeting. Or let's say if you are an international company, you borrow money in various forms, directly from the banks, maybe you issue bonds in US dollars, all that stuff. This clarity in terms of how the interest rate direction is would provide you in terms of financial planning best situation you can ever have, and it will solve a lot of problems for you. Next layer is if you are a portfolio manager of fixed income, especially in international fixed income, this clear direction of US interest rates will also provide you with the leeway as to how you want to change your portfolio construct and the tilt of your portfolio in terms of the lengthening of duration. That means you buy longer term bonds or you buy shorter term bonds. All that will be much clearer to you as the US Federal Reserve progresses on this path. All right. So effectively, the clarity that was lacking before towards the end of last year and beginning of this year of interest rate trend has been eliminated with this. Number 3 is Federal Reserve has talked about shrinking the balance sheet because they inject a lot of money into the system, and they talk about 95 billion reduction every month. Now, what happened is if the US have pumped in 100 trillion US dollar into their own system, all right, that means that also brings the money market money rates to very, very low. And you are starting to reduce this amount of free money available in the money market. What it means is the cash available for banks to borrow from the money market will be reduced, and that will have an impact on money market rates. That means the rates that banks lend to each other, borrow from each other, that rates will be affected. Most likely it will go up. That will also have an impact on overall funding costs for people. And number 7 is Mr. Powell, the chairman, says that recession is not particularly elevated. I would say that means he's talking about 30%, no more than 30% of a recession. Of course, this is premised on the fact that eventually the Russia-Ukraine issue will be resolved, and hopefully our thinking is hopefully by middle of this year, we see some clear progress. All right. And just as a picture of this, dark blue line gives you a very clear picture of the interest rate trend. And if that is the case, that tells you to some extent, if you are planning on your financials, you can even start doing your budget for 2023 and back into 2024. And and if you are a guy who issue bonds for financing in US dollars, this is also very good for you. And if you are a portfolio manager of fixed income, this particular direction is also very clear to you and definitely will benefit you, ease your life as a portfolio manager as to how to position your fixed income portfolio. What it means I'm trying to say is please start to look at fixed income port investments more clearly, because clarity has improved, and usually clarity has improved usually also signal the fact that returns from the portfolio, fixed income portfolios, will also improved. Unlike last year, which was near to zero or mildly negative. All right. So this is where I believe, as an overall portfolio, you invest for yourself. You have ask yourself very seriously, how do you want to think about getting an exposure in the fixed income part, all right, your asset allocation. So that brings about 2 levels. Remember just now I talked about the Asia Pacific growth coming back. So there could be a reallocation of resources from developed countries to Asia Pacific. So that reallocation could come in 2 phases. What sort of equities to buy in Asia Pacific, as well as what sort of bonds that you should want to think of you want to buy as well. So this is something to seriously consider. That means you actually add more variety and able to diversify your risk even better with bonds coming back into the picture very strongly. All right. This is just a scenario that we have. We're not going to talk too much about that. And something is China, second largest economy. I think what happened is they have made very clear statement. They want to support the economy. I think they have made some tentative move last year and this year by cutting RRR. I think as of yesterday, they also said that they will be cutting RRR soon, and I think it will be done this Friday. All right. So what you have is the China is focusing on supporting growth based on you can call it relatively short-term measures, like for example, cutting rates, providing liquidities, and they are talking about a large infrastructure budget of 2.6 trillion, and that will provide able to sustain your growth for the next 2 years. And going forward, they talk about measures that you get other than that, they talk about the measures. A few things has happened. One, they talk about the fact that they have made some progress with the negotiation with US on ADR listed company in China, talking about willing to share their accounting data. You have Alibaba who signaled that they're going to start a 25 billion share buyback, which actually means signal that the government, in terms of regulatory changes on big cap technology companies in China, is likely to be over. All right, so you do have also pretty strong clarity on what China wants to do. What now is to see is for them to talk, do the actual strategy, announce the plans that they want to do, and talking about supporting growth in the short term as well as long term. Now, over the long term, I think all of us are quite clear what are the things that China needs to focus on. One, make sure that the property sector do not create issue for them again going forward. Two, by this year or next year, China will be an aging society. That means people of age 60 and above will be 20% of the population, and they have very low child birth rate of I think about 0.5% annually. That's very, very low. Malaysia is still slightly above 1%. Now, once you have something like that, you have aging society and low childbirth, that means your population could drop. Population would drop, will have implications because your workforce will drop, and your people, there will be an implication on your consumption. And this is something that the Chinese government need to address, as well as the fact that income distribution in China the gap is huge. All right. We will talk about where the opportunity that we see in China. Let's talk about the opportunities in China going forward in the world. ESG is something becoming very mainstream as an investment class. It's not just ESG, it's talking about sustainability, and sustainability is something that is going to be something we breathe and do. Just to give you an analogy on how sustainability is about, those of you who have read material on economics and all that stuff, there is always this term in economics which says unlimited wants but limited resources. That means, voila, you have a lot of wants, but resources in the world is limited. So to stretch that resources, to satisfy everybody, this is where sustainability is important. A more basic one is when I start work back in the 90s, my pay is 1,002. I have to pay for I have to pay for rental, pay for my food, give my parents some money. So to stretch the dollar over the month where 1,002 ringgit better work very hard. And this is also what you talk about sustainability as well. Next, and in terms of sustainability, green, we talk about EVs, renewable power, energy efficiency. This is in terms of the sectors, stock selection that is available. Portfolios across will be thinking of how to get into exposure to this. Then we also talk about the industrial revolution. We also talk about fintech, 5G, green tech, and biotechnology as well. So going forward, the next few years, portfolios around the world will be changing significantly, focusing on ESG as well as all these new themes that have emerged over the last few years. And these will be the things that people will be looking at very, very closely. Something to look at also in the shorter term is the fact that after the big rally over the last 2-3 years, the big cap stocks, whether in China or in US, have become very expensive. The valuation gap between large caps and the small mid caps is big. And as you can see here in terms of S&P and also the large mid caps companies, the valuation gap here is quite large. And you look at in terms of valuations, S&P 500 is almost near to record high in the year 2000 .com periods. All right, we almost tested the high as well. Of course, they're consolidating, but what it means is large cap in US are still expensive, and you look at concentration of the stocks in S&P 500 is extremely high, and this is also telling you to some extent, I don't want to call it a risk, but this is something that as an investors you need to be aware of and how you want to tilt your portfolio in such an environment. All right. Next, of course, we still continue to like Asia. Asia as a whole, in terms of whether it's North Asia and ASEAN, I think there's a lot of potential in terms of population structure, technology growth. I think North Asia has been more the leader in terms of technology development in Asia. All right, and particular also in China, we have Korea and Taiwan. We are major player and have global players in terms of as a technology sector, all right, whether software, hardware as well. And the other thing that is driving is that you can see previously dark blue line, see talking about earnings revision. That means corporate guidance on profit. The dark blue line, which is Asia Pacific, has been negative downward revision, and only recently back into zero, which is actually a positive development. And as you look at it, developed countries, for example, US is starting to dip to negative revision with the relationship in terms of GDP growth. And what it tells you is there is earnings. Of course, we do not deny that Russia, Ukraine would actually stall this a little bit, but we believe that once that is over, this is where we believe that the market will start to look at the fundamentals, and I think the earnings revision number will be something that people monitor very closely as to how their asset allocate between developed countries and Asia Pacific, and also as well I stress also between equities and bonds. All right. And generally, we believe that reiterate that the worst is over for China. We think that they need to, other than the short-term measures to sustain growth at 5.5 for this year and next year, I think they need to address a few things which I managed before: population, property sectors, as well as the income distribution issue, which is talking about common prosperity. Let me give you a statistics. I think 40% of China's population have about an annual income of about 14,000 renminbi, which is slightly more than 1,000 renminbi a month. But China's per capita income is already close to 75,000 renminbi. Suddenly you ask yourself, wow, 40% is 14,000, but suddenly you tell me national per capita income is 75,000 renminbi. So you can see the gap is extremely big. We know that to achieve equality is impossible in this world, but you can try to narrow the gap. I think the best way to narrow the gap is to have certain policies in place to drive that in terms of whether you're going to have minimal salary strategy, develop more industries, talk about different in tax structure for the rich and the poor. What you want to achieve is to have as large as possible a middle class income. And once you're talking about you're having a large middle class income, which I'm part of it, then you have this particular scenario, husband and wife together, joint income, you are able to buy a house and have each maybe have a car each or something like that. Maybe going forward, one may not need a car with autonomous driving, Grab and everything will be the norm or something. And with your income level at a comfortable level, you'll be more induced to have children. And that effectively will be a indirect, better way to resolve the issue whereby China talk about one-child policy, they talk about two-child policy, and now talk about three-child is better. You need to drive the income to people to be incentivized to have anything. Without the income growth, the level of income, as well as the possibility that you are able to buy properties. And to some extent, I think in this part, other than policies to stabilize and control highly geared property companies, I think the Chinese government will most likely adopt a similar strategy that Singapore has done, the HDB. I think that is definitely something on the cards which the Chinese government want to think of and to provide. Once you have stability of a place to stay and your income level is high together, then you seriously consider what you're going to do next. And most of the time you talk about child or two, right? I think that will be a better solution as to how to solve the overall longer term issue that China growth. What I'm trying to stress here is in the drive to achieve better income distribution. There will be a lot more investment opportunities that arise in China over the next 5-10 years or even longer. What that means is effectively you think seriously consider how you want to position yourself as well in terms of that. All right. The other one, to talk about ASEAN. I think fundamentally ASEAN has been very strong. We have, of course, everyone have their own issues, whether it's political or whatever. But generally, ASEAN as a country, as a people look at it as a pure brick and mortar. We have a lot of banks, a lot of communications, telcos, and industries. But what it has done is people are looking for, as I mentioned earlier, even in periods of high volatility, there are asset classes that perform, and ASEAN has performed. And ASEAN this time round have benefited from a few things, right? One, in periods of volatility and current environment, people look for value stocks. That means you talk about banks, all right? And in ASEAN, banks is 35-38% of the market. You are net commodity exporter of commodities. Thailand, Malaysia, Indonesia, Philippines are good have lots of commodities, and that's why you have Indonesia performing very well, and that help drives overall ASEAN performance. And Singapore have 3 very large banks that have attracted a lot of attention, and that also helped that. The other thing that has happened the last 5 years, right? ASEAN continue to be a haven of FDI, especially after the 2018 trade war. People talking about China +1, China +2 manufacturing base, and especially after COVID-19, with the supply chain disruption, people are talking about definitely ASEAN will be a beneficiary of FDIs other than China attracting production. And ASEAN as a supply chain, supplying to US and Europe, 28 countries, we are talking about, we have overtaken China. And this is, I think, very, very important. The other one that is happening is ASEAN is not lacking in terms of participating in the new economy, whether it's Industrial Revolution 4, the digitalization, or e-commerce penetration like Lazada, Shopee, and everything. So this is a phenomenon that has been very strong in ASEAN over the last 5 years, and we have our own unicorn, right? Touch and Go, Grab has got listed, C is listed as well. Recently, there's a company called Custom in Malaysia, which deals only with second-hand cars, but they also reached unicorn status by being valued at USD 1 billion, and they have reached that type of funding. What it has is it provide dynamism to the overall entrepreneurial spirit as well as the capital market in ASEAN. And this has made ASEAN overall more attractive as a place where people are willing to park their money other than being a provider of what I call the value and growth and all that stuff. But ASEAN is not lacking and trying to catch up with North Asia in terms of technology development as well. All right. And fundamentally, ASEAN is actually very attractive. As you look at them in terms of dividend yield, ASEAN is the highest in the world, at over 3%. All right. In terms of performance, ASEAN do not lag the world. And you look at this earnings revision in ASEAN are starting to improve. And this, I think, would support the argument for, as a whole, for money to flow for Asia Pac. If ASEAN is up there as well, I think money will come. As I mentioned before, people look for opportunity to invest under any circumstances, any volatility. And I think ASEAN at this point have proven the point that we can come through when times are tough. Right, and in terms of earnings, you look at the gold bar there, ASEAN is looking relatively attractive, whether it's on a PE basis or on a price to book basis. Valuation in ASEAN is attractive, right? And in terms of volatility, beta ASEAN is lower than almost every other region in the world. All right, Latin America, emerging market, and Asia Pacific region as a whole. All right. And not to mention the latest trend in terms of adoption of ESG. If you look at it, Malaysia have accelerated the adoption. Even Thailand is still lag behind. Back only 4 or 5 years ago, it's not back to above 80%. And you look at it, we are to some extent as well as good as European countries in terms of in Asia Pacific. So this is where I think attracting the dollar for investments in various sector is very important. And just to highlight, Even in Malaysia, you look at the last column, plantation, which was previously a lot of highlighted by the foreign media that not ESG friendly. We are making a lot of progress in terms of that as well. All right. So this is where I believe as a whole, things are always changing. Entrepreneurs are always dynamic. They always seek to improve the investability story of their companies. And I think what you see here is a very strong testimony of what is happening. Okay, ladies and gentlemen, that's done with my presentation for today. On the big picture basis, I'll be very happy to take questions on the situation on the thing. I'll be happy to take questions now going forward. Thank you.
Okay, thanks, Mr. Wu. Good to hear some progressive economic sign and measures put by the policymakers. But before we take some question, right, I'll share the existing promo and also ongoing promotion today. So give me 1 minute for me to share the slide. All right, so good news for those that attending our webinars today. We have a special promo code for you, which is Principal Webinar 2022. I repeat, Principal Webinar 2022. So be the first 20 customers to top up at least 500 ringgit using your cash or 1,000 ringgit using EPF savings. Then you're entitled for 30 ringgit Touch and Go e-wallet reload pin, subject to terms and condition. So I repeat the promo code exclusive for those that attending our session today only, Principal Webinar 2022. Secondly, this is our ongoing campaign ended end of this month, 30th April 2022. We are giving you additional extra 4.8% per annum in the form of Touch and Go e-wallets. So you can look at the table here. It's depending on your investment amount, total accumulation during campaign period. The first tier will be from 2,000 up to less than 50,000 ringgit. We get 3.8% per annum for 1 month. Second tier will be between 50,000 to less than 100,000, 4.38% per annum for 1 month. Third tier will be 100,000 to 199,000. 999 ringgit, we get 4.6% per annum, and the highest tier will be 200,000 and above. You will earn 4.88% per annum. So don't miss out this opportunity. While you can see that some good sign of the market, so I guess progressively you can put some money in our fixed income, equity, balance. So make it an asset allocation. So participate on our campaign here. For this campaign, the promo code will be Get Extra. All right, so let's go through to our Q&A session. So we have a few questions posted here. So the first question for Mr. Wu, with GDP not growing, inflation in a records high, are we living in stagflation economy?
Let me put it this way. We are not in stagflation. Stagflation is in a period whereby your growth is very, very low. 1% or less, and you have inflation exceeding 10%. It's like you have your roti canai today at 2 ringgit. 1 month down the road, 2 months down the road, you become 250. Another one down the road become $3. That's stagflation, and that is something you don't want to be in. And hopefully, this is why I say the trying to resolve the Russia-Ukraine war will be something very important in terms of avoid coming to any situation near to a stagflation.
All right. So next question, do you think cryptocurrency has the capacity to overturn current banking and financial system?
I have to tell you this, your cryptocurrency generally do not have legal standing. It do not represent any country. All currency in the world is backed by the government. All right. The government protects the currency. You want to take cryptocurrency as an alternative investment product? Yes, but to take over the world, then you have to ask yourself, all you need is US to say, I declare cryptocurrency illegal and I would not allow it to be traded using US dollar. Then can you imagine what happened to it?
All right. So the third question for you, As China still stick to COVID zero policy, in your professional opinion, where do you think that China economy is going?
China economy is definitely slowing, and what they have done is only stress the fact that they need to quickly announce more measures, better thought measures as to how to support growth. All right. It's unfortunate China need to do zero COVID thing, but then if unfortunate, it's because China is highly dense. The big cities, the city is packed with people. And COVID-19, even though it's the Omicron one and it's not as deadly as the previous one, but once you have it uncontrolled, it will be something quite difficult for China with such a huge population to actually do it, and the impact on the economy may be worse if that happens. So that's why you have to understand why China had to adopt this.
Okay, so next question, what is your take on precious metal? What's the outlook for 2022 and 2023 next year?
Precious metal usually is a hedge for inflation and uncertainties. All right, of course, we have both now. We have inflation and political uncertainties. That's what it is. But if the political uncertainty can be diminished, which also will help in terms of reducing the inflationary expectation, then your precious metals generally will be caught in a range bound. To achieve new highs will be quite difficult. You can have it as a strategic allocation in your overall portfolio, a certain percentage. I think that's fine. But to make it as a very important part to grow your overall NAV, then I think it may not be exactly the right thing to do.
All right, so I guess this is the last question. This is a bit longer. Yeah? So in terms of valuation of the country selected, for example, developed country and growth country comparatively, so may I know what strategy you may take, and will you consider reducing or to increase the quota like percentage of each country total portfolio allocation? So I guess this one is referring to our existing funds holistically.
Well,
in
I
general.
would put it this way. You look at purely fundamentals, you cannot ignore the fact that Asia seems to be have better clarity in terms of growth potential, and ASEAN's clarity is even better, right? Because of that, US and Europe seems to have faced some issue because they have the direct issue with the Russia-Ukraine thing. So at this point, and you talk about the GDP numbers as well as the corporate earnings numbers, then as a whole, you may want to hold more of developed Asia Pacific countries rather than developed countries. But that will also include the bonds, please. It does not just focus on equities, because you have to be very sure of your own risk profile before you do anything. And to tell the truth, if things do normalize, US and Europe have dropped more, I'm not surprised if the market come back, all right, for them as well. So you have to be quite clever in terms of how you tactically allocate. But on a fundamental basis at this point, if the on a net basis Asia Pacific look better, then you have to be, to some extent, you may want to be tactically have more Asia Pacific products, whether it's bond and equities, or how you want to mix that is entirely up to you.
All right, so we
That has to
just have.
reflect your risk profile. Yeah.
Okay, thanks, Mr. Wu. So we just received another question. You mentioned that fintech as one of the fast-growing sector to look for. So
Yeah.
how does the company's sustainability can be improved, which currently only at 15%?
Well, fintech involves a lot of things, not just your normal banking. Even a normal bank can have fintech being a larger and larger part of its overall operations. Like, for example, transaction over the internet or over an app. I think nowadays, for simple things, I think using an app to transfer money to your wife, your kids is very easy, right? Rather than going straight to the bank, and you don't even go to the ATM machine now. That's part of the easy part. The rest will be in terms of the applicability of the app or the credit card or whatever globally, and how do you have a standardized platform across the world and all this stuff. And to some extent, all these to work properly will need the backing of a technology called 5G and 6G and 7G, because you need the speed do that. Right? Previously, some of the technologies are not so applicable, it's there, but not so efficient, because you need the speed to do that, to achieve that type of level of transaction or all the stuff, and also for security, right? But now with the 5G available and being implemented more aggressively across the world, I think this is where a lot of these things will be even more, not only in terms of fin technology, even the e-commerce penetration, online buying. I think the COVID-19 lockdown have already given an example that, the potential of that.
All right. So I guess that's our last question for the day. So thank you, Mr. for your sharing and input. So everyone, thank you very much. We appreciate you being here. So take the opportunity to invest in our enhanced principal online portal, and of course participate in our webinar promo. So most importantly, start your investment journey with Principal. Thank you again for joining us today, and we shall see you again next time around. So take care and stay safe. Bye-bye.
Thank you everyone for attending. Have a good weekend and please continue to observe SOP. It's very important. Thank you
All right.
everyone. Bye-bye.
All right. Thank you. Bye-bye.